Let's talk a little bit about the future. We're already a little bit into 2014, so it's cheating, but 1/6 is not enough to matter. So global growth in 2014 should, by everyone's estimations, accelerate. Except the dynamics are going to change a little bit. So spend a moment with me on this one. The Eurozone will move from recession into expansion. The U.S. will maybe tick up from a 2% growth rate last year to maybe a 3% growth rate this year. Where is all that growth coming from? Well, the governments are actually less of a drag in those economies. Think about the sequester in the U.S., et cetera. And so we should see a decline of government austerity, and that's going to help the developed world. China is going to produce the lion's share of growth, but notice that China's growth is actually downshifting. So there are some shifts in terms of the global growth dynamic, but overall, if you map it together, the globe should grow a little bit more than 3.5% this year, which would be an uptick from the 3% we saw last year. Unfortunately, global GDP growth is stuck below trend. So this isn't the recoveries that we're all accustomed to. And so let's take a little time and look at the United States relative to recovery history. So really, U.S. GDP recovery growth has been anemic. This line, and there'll be a series of them, so get acclimated. We'll show you the slope of the current recovery coming off the bottom relative to the average of the past 7 recoveries and the range of the 7 recoveries. So you can see we come in decidedly weak when it comes to GDP growth off the bottom of the recession. Now, personal consumption expenditures, that's you and I going out and buying stuff at shopping malls. That ends up being about 65–70% of the national economy. And you can see in this current recovery, we hadn't been running out and spending nearly like we had in the past. And if you look at government spending's actually been a drag on the economy. Now, this doesn't include transfer payments, so this doesn't include Medicare, Medicaid, Social Security, and all the entitlement bloat that we're talking about. This is the government spending money on goods and services. Think austerity. It's been a drag. And if you look at business spending, investment activity is actually, as a percentage of GDP, at kind of recessionary levels right now. It's bounced off a low bottom, but still rather anemic. So when you add all this together, it ends up creating an environment of pretty pitiful jobs growth, as you all know, relative to the past. And what really grows economies is people working and being productive. So if you want more growth, you want more jobs, and you want more productivity. And right now, productivity's been weak, and job growth has been weak as well. So that begs the question, what is the deal? Why can't we seem to get this thing back to the cruising speed that we're all used to? Well, this is why. Okay, remember we went through this big financial crisis, and the reason why I draw your attention to that, although it was 2008, is I think people kind of moved past it and think maybe we're all clear. We're not all clear. We are still in an environment of deleveraging. And what that means is that the total credit out there relative to GDP is actually falling. And that is a natural depressant on economic activity. So there is this downforce that we're dealing with where in the typical recovery, it would be lift because credit would be growing faster than GDP and creating, therefore, additional GDP. So we've got a natural depressant on the global economy. Notice, too, that the turmoil is really more in the advanced economies, right? The US, Europe, Japan, Canada, et cetera. And there's less debt to GDP in the emerging economies. That's an interesting scenario given the fact that the papers, of course, have got us all concerned that some of these small emerging economies are going to take us down. But the bulk of the work that's being done is actually in the advanced economies. So what do you do about this? You got this disinflationary force, if you will, in terms of deleveraging. Well, if you're a central banker, you print money. It's not just the U.S. that's printing money, it's everybody. So if you look at policy rates, and that's the left side of your chart, you can see that the emerging economies and the developing economies have taken their overnight lending rates down to 0. They've also both ended up printing money to buy assets. And so the idea is, with credit to GDP coming down, why don't we just make money as cheap as humanly possible to see if we can offset that force? And that's what central bankers have done. So they've done everything they could. But that hasn't produced enough demand for money to offset the supply. And so what's happening is we're seeing this monetary velocity spiral a little bit downward. And the bigger threat on the planet right now is not inflation, it's deflation, perhaps, particularly in Europe. So there hasn't been enough demand, and what are we going to do about it? So you've got this deleveraging force pushing down the economy. You've got this central bank activity that's pushing up the economy. What are we missing? Well, we're missing some policy response. So what we need is GDP growth that's faster than total credit growth. But the third leg of the stool are the economic policies that come from the central government. So there's a clash here, right? So the economic prescription right now to offset delevering with the help of the central banks is that we loosen up on the private sector. We lower taxes. We increase private sector incentives, because what we need is the private sectors to grow us out of this. Unfortunately, this is not just a condition in the U.S. History shows that after financial crisis, that displaced populations of workers and people are bitter and it becomes a class warfare thing. This isn't just the U.S., this happens throughout history. And so it becomes kind of the politics of revenge. You know, we need to sort of rein in the private sector, and we need to rein in salaries, and we need to do everything we can to have control over our assets. The government controls assets, and so we use the government as a central control mechanism. And what that does is end up being the opposite of what we need, because we've got this policy response that's kind of leading to austerity in the private sector. So the economics call for liberating the private sector, but the politics call for, suppressing the private sector. So the policy response is at odds with the economics. So that's why we end up in this lower GDP growth rate. And really, ultimately, since we elect people, it's been our choice.